So how do we create money in our economy? The first is we print banknotes or we manufacture coins. Okay. The second is that we create money through bank lending. So when banks lend money, it adds to the money supply. And we looked at how bank lending adds to the money supply in the previous video. So let's just do a little bit of review on how bank lending adds to the money supply. So let's assume that the target reserve ratio is 30%. Okay. And let's say that we deposit $50,000 into, we'll call Bank A. Okay, so $50,000 goes into demand deposits in Bank A. Okay, so what is the target reserve? How much has to be held as cash? So the portion we have to hold as cash is 30%, so we're going to take 0.3 times 50,000. Okay. And 0.3 times 50,000 is 15,000. So Bank A must hold 15,000 as cash. Now how much excess reserve? Okay. Excess reserve is the amount left over after the target reserve. So we had 50,000. 15,000 had to be held as cash, which means the remainder, 35,000, is excess reserve. Well, what do banks do with the excess reserve? They lend it out. So Bank A can lend 35,000. And let's suppose that they lend out 35,000 to a customer in Bank B. Okay? So then they're going to deposit 35,000 into Bank B. Now, what's the target reserve? How much does Bank B have to hold of that 35,000 as cash? Now, 0.3 times 35,000, and we get what? 10,500. And then how much is left as excess reserve? Well, 35,000 minus the 10,500 and we get what? 24. Let's try that again. We get 24,500 of excess reserve. And that 24,500 can then be lent out, and it can go to a customer in a different bank. So the question is how much will the money multiply? So what is the money multiplier? To find our money multiplier, we do 1 divided by the target reserve ratio, so 1 divided by 0.3. And when you do that, you get 3.3333, and it keeps going. So we can put a little line above the 3 to note that that 3 keeps going. So that means that when we deposited the initial 50,000 into a checking account, what happened to the money supply? Well, the money supply increased 3.33 times that 50,000. So what's happened is our money supply has increased by 166,660.66 so we'll just round it there at 166,667. So we can see how bank lending has increased the money supply. The money supply has multiplied. Now, we talked before about what impacted the money multiplier. And so when we talk about that impact of that target reserve, we have to have money in the checking account, customers who want to borrow it, and banks who want to lend it out. Now, if a bank runs out of reserves, doesn't have enough cash on hand, because maybe our target reserve is 0%, if they don't have enough on hand, then if they are a federally chartered bank, they can borrow from the Bank of Canada. If they are a provincially chartered bank, then they would need to borrow from the province. If they are a near bank, then they are privately insured, and it would be that insurance that would be where they would get the funds. Banks can also borrow from each other, and we're going to look at that in a moment. So we can print money, we can lend money, we can change that target reserve ratio. If you change the target reserve ratio, it's going to change the amount of money in circulation. And then we also have quantitative easing. So what is quantitative easing? Well, quantitative easing, we started to see the surgence of quantitative easing in the 2000s. And the reason is because at that point, most countries in the world had already lowered the rates at which banks could borrow from their central bank. So that's the bank rate. So this is where a bank borrows from the central bank. And those rates had already essentially reached zero. Right? So if banks can borrow more money from the Bank of Canada, then they're going to lend it out, right? If that bank rate is already at 0%, then banks can borrow essentially as much money as they want to lend out to people to stimulate the economy. Well, what do you do when you've already lowered that rate to essentially zero, and you've lowered your target reserve requirements to essentially zero? So you're trying to stimulate the economy, but there's just not enough lending and borrowing happening. Well, then we have what is called quantitative easing. And quantitative easing, we use, of course, when the bank rate is already close to zero, our target reserve is already low. And this is when we are creating what's called ex nihilo money. Ex nihilo money means out of nothing. So here we are essentially printing money, but instead of making coins or manufacturing banknotes, what we're doing is we're creating more electronic money. So when you've heard the term printing money over the last decade, they've really been referring to quantitative easing. We're creating money out of nothing. Okay, well, how does this work? Well, to stimulate the economy, we want businesses to spend, we want the government to spend, so maybe the government is building roads, hospitals, schools, and they need money to do so. So the Bank of Canada will buy government and corporate bonds. So remember, bonds are an IOU. So basically the government wants to spend money, they don't have the money, they're going to do deficit spending, right? Accumulate debt. Well, when they create a bond, they're essentially selling their debt to someone else, right? You give us money and we'll pay you back in a couple of years. So if governments and corporations issue bonds to finance their spending, they're essentially accumulating debt. We'll pay you back later. Well, how do they get the money then for that spending? Well, the Bank of Canada bought up government and corporate bonds by creating money to do so. Ex nihilo, money out of nothing. They created electronic money and they put it into the government's bank account. They put it into corporations' bank accounts. And so now these companies and the government have more money to spend and expand. And so 2008 to the present, well, really 2008 to about 2016, we see a lot of quantitative easing. Canada, the UK, the US, they're doing a lot of creating money, buying up corporate and government bonds to get companies and the government to spend to help stimulate the economy. Now what we're seeing as of late 2016 and into 2017 is a reduction in quantitative easing. So pulling back on that ex nihilo money, basically cashing in those bonds and pulling the money out of circulation. So it's a way to add money to the money supply to get people to spend by basically creating money to buy bonds, right? You're lending money to companies and the government to get them to spend. And now as we start to reduce the quantitative easing because our economies are doing better, then what you're seeing is that ex nihilo money being pulled out of circulation. We cash in the government bonds, we get the money back, and then we just make zeros disappear from the electronic account and make the money go away. So quantitative easing over the last decade has been a popular way to increase the money supply, because when we look at how to create money, we already had banks lending as much as they could because we reduced the target reserve requirements, we reduced the rate at which banks could borrow from the central bank, and still it wasn't stimulating the economy enough. And since most of Canadians don't actually use a whole lot of currency or coins, right? It's only about 3% of the money supply. We needed more electronic money. And so quantitative easing is what we used.